We are 12:01. Welcome to our Colorado Multifamily Development Fund webinar. We're getting started here in about 30 seconds. We have people rolling in. If someone could just drop in the chat that you can hear me, say yes, or tell me what part of town you're in. I always like to make sure that the microphone is working. And I see some yeses. Great. Thank you. Thank you. And while you're at that chat box, don't go too far away from your keyboard. We love questions interaction. So if you have any questions or comments or thoughts throughout this webinar, please go ahead and put them in the chat box. And we will be answering them either throughout, or I might hold off for a few minutes for a later slide if you got a little ahead of what we were presenting on. But to officially kick things off here, since we have people rolling into the room now, I want to welcome you. I'm Chris Lopez, and we're here today to talk about the Colorado Multifamily Development Fund with NARRATE Holdings, who is a Denver-based developer. And we're going to talk about the overview of this fund and the three main projects in here. But of course, quick disclaimer here, we're not your CPA, we're not your lawyer, so always make sure you're out there talking with your legal and financial team before you make any investments. We are using some forward-looking statements and numbers, and these are, company source data that we have pulled from our resources and our reports. And also, this webinar does not constitute an offering. That will come in the form of a PPM and some other legal documents. That will be the official offering. If you're interested, we will send you those after the webinar. But to kick things off here, I'm joined by the founder of NARRATE, Adam Fenton. Good morning, Adam.
Hey, good morning. Good morning. Thank you for having me back. It's been a few months. So
yeah, I'm excited. Two things I love about doing with you, Adam, is either walking properties or talking deals. So I get one of my two favorite things
there
with you.
Go.
So we'll give Adam the official introduction here in a few minutes, but want to just kind of do a quick run through the agenda. We'll kick things off with an executive summary of the fund, just high-level projects, high-level return timeframes. And then the presentation, I've kind of broke this down into a lot of the ways that I evaluate deals. And also this is how we initially, evaluated NARRATE and this deal for our due diligence. And number one, always look at the sponsor. What's their track record? What's their background? That's item number one. Item number two is, does what they're doing make sense in the geographic market and also the general macro market timing? We'll spend a few minutes talking about that as step two. And then step three, and this is the third layer of due diligence understanding, in my opinion, is we'll go through the three projects in this fund, give you a high-level detail or high-level overview with all the details in the slide deck. And the thing that's really cool here, and we'll get into more details at the end, we're actually going to do a bus tour in about mid-February. We're going to meet at our office here. We'll drive to 4 sites. 3 of them are here, and that one's just on the NARRATE project. But we'd love to actually have people come out and meet them in person, but most importantly, walk the sites.
Yep.
And then we'll end up with just high-level investor returns and next steps to invest. I see a few people say they are interested in the bus tour. If you're interested, let us know sooner rather than later. We are getting a big charter bus tour, but there are limited seats. And so we already have about, I think, a dozen reserved for investors plus some team members on top of that. So let us know if you want a seat, and we'll go ahead and reserve you one, since I do expect it to fill out, before the end of January. So executive summary. NARRATE, the sponsor, is offering accredited investors an opportunity to invest in 3 Colorado multifamily projects, 1 in Denver and 2 in Colorado Springs. So one's a 65-unit luxury multifamily in Denver's Wash Park neighborhood. So one of the great neighborhoods, and one without all the cranes like other parts of Denver. And then the second project is downtown Colorado Springs called Canopy. It's a 183-unit Class A with some retail on the ground floor. And it is core downtown Colorado Springs, amazing location. And the third is a 120-unit multifamily attainable housing near the University of Colorado Springs campus on the north side of town. And there's lots of great things on that part of town. So why we like this fund as Property Llama, and we're excited to partner with NARRATE on here, is first off, we get diversification across 3 distinct projects and 3 distinct submarkets: Wash Park, Downtown Springs, and Northern Colorado Springs near the campus. it's a very opportunistic timing in the multifamily cycle we're on, with anticipated delivery during very strong demand and a very strong sellers cycle in the market. And then Narrate and Adam and his team, their experience. This is not their first project. This is not their 10th project. They've done a lot of these with a track record. They're also investing part of their own money into here as well. So they have a strong GP co-invest. And of course, these submarkets are also capitalizing on where population growth and demand is coming into Colorado. One of the deals has extremely attractive HUD financing. And there's also multiple exit strategies, which is so fun. So, Adam, can you give us an overview about kind of the two exit options on here? Because I know we went back and forth on here, and you've delivered option A, which is great, and option B, which is great, just depending on what people want.
Yeah. So what we try to do is build in a lot of optionality when it comes to our investors. And what we've looked at here is a 48-month hold scenario and a 120-month hold scenario as well. And in a long-term hold scenario, it could be a little shorter. It could be 8 years, could be 9 years, right? We really look for opportunity, but we're really setting up these up. We like these from the long-term perspective of what's going on, throughout Colorado, these submarkets specifically. And then we'll get into it, but Canopy is, a QOZ, which there's a lot of benefits to holding that 10 years. But what we try to do is build some optionality in here for investors to be able to get out of projects earlier, rather than sitting there and holding it for the entire 10-year hold period. And there's a lot of flexibility around that even as well. And that details of that will become will be coming down the line further of exactly what it looks like. It depends on if we bring a large LP investor in and some of the nuances with them. But essentially there will be an opportunity to get all of your money out after, and these are rough time frames, right? It could be 36 months, it could be 48 months. We've ran it at 48 months. But there's going to be an opportunity for investors to get a portion of their money out of the project, all of their money out of the project. They can leave it all in, they can invest more. But essentially you run through kind of I call it a phantom sale, basically. And at that point in time, you can get, sales proceeds and free to do kind of whatever you want to do with them at that point in time regarding the deal, whether it's take it all out, leave half in, leave 100% in, put more in. There's a lot of optionality around that. So we build that in for ourselves as developers on the project, and then also offering that for investors who come in a little earlier, prior to that vertical construction.
I love it. So exit one here. Let's talk summers here. This is the 36 month to 48 month. Now this is model is 48 months.
Yep.
Now I've got,
I would say too, Chris, what we're looking at here is a combined cash flow.
Yes.
So these are combined returns for all three deals. And that's why you see a little bit, your cap rates look a little wonky. And the reason is we're running, and this is later in the presentation, but the exit cap assumption on South Logan and Canopy is 5%. We're at 5.5% on Weber, and the reason for the difference in cap rates is just different submarket, different product type. So we adjust for those, so that you're kind of seeing a weighted average cap rate. So that's why 5.17 seems like kind of a weird cap rate, but that's what you're seeing there. It's really a blend of the three. So I think that's important to point out here.
Oh no, that's great. And the other thing important to point out is we're going. I don't know if you can see the green highlight on here. It's the very first row at 5.17 on the 48-month hold. And so this is the 3 to 4 year hold, and this is much more IRR driven. So, option one is, hey, if you're just, we want to be out, 3 to 4 years and have a higher IRR, we're estimating, a low to mid 20 IRR. But one thing I like about Narrate and Adam is that they are conservative on their underwriting. And so you can see there is definitely some upside based on cap rate compression. So, hey, the lower the cap rates go, the more money we make on the sale.
That's correct.
So if cap rates drop, you can see, hey, it might be pushing a high 20, even a 30% IRR with the respective, equity multiple on there. And then the long-term hold, the 8, 9, 10-year hold, again, this is a modeled 10-year hold combined, be a lower IRR in the, mid to high teens, but this is a lot more for people in the longer hold time. And, right around starting that 4 year mark,
Yep.
probably around an 8 to 10% cash on cash
Yep.
return.
Yep.
So strong clipping of coupons
Yep.
there.
That's correct. That's correct.
So we'll go to more details on here and all the underwritings on here. But what I like about this is 2 options. And you can see, hey, we've got our base case conservative with definitely some realistic upside based on project and most importantly, market trends.
Yep. I think that's important to note there, Chris. What we try to do here, and it's in the narrative, but we our exit cap in 4 years. I'll just concentrate on that one now. We're 50 to 75 basis points above where it would trade today, right? I know for South Logan, for example, right, we're running that at a 5 exit cap. There was just a trade earlier this month that was at a 4.25 exit cap. Very similar type product. So when you talk about trying to build some conservatism in, I guess, I don't know if that's a word.
It is now.
It is now. But we try to look at that and not be very super aggressive. And look, we don't know what cap rates are going to be in 48 months. We don't know what they're going to be in 120 months. So we just try to use the best knowledge and information that we have at that point in time with the current market and make adjustments to our model based off that.
Yeah. And a common question we get, can a person do a 1031 exchange in this fund? No, you can't. But as Adam mentioned, Canopy is actually a qualified opportunity zone, or QOZ, that offers very similar tax advantages to a 1031, but a little different. So if you have a property you sold in the last 6 months, or you're selling one and you're not happy with 1031 options, put this on your radar. In a couple of weeks, we'll be doing a deep dive into that deal in the QOZ.
Yep.
But I'm looking at selling a fourplex and potentially up to like $500,000 into the QOZ. So it's very attractive. So if you're in the 1031 or property sale disposition, you can't do 1031,
right.
But QOZ, I'd even say it might be better from my perspective, not legal advice.
Yep.
But put in your radar. If you want details on that, let us know. We'll add you that webinar in a couple of weeks. All right. So moving on to actually the deal. And I said there's 3 things we look at. Most important is being sponsor.
Yep.
The sponsor is who's the operations, who's the boots on the ground, who's doing the deal. That is Adam and his team.
Yep.
So correct. Adam, who is NARRATE?
So NARRATE, we were, I started NARRATE about 5.5 years ago now, August 2019. We've since morphed a little bit since then, and Zach Kobilka and I joined forces a year and a half ago. We'd been longtime partners with separate companies, and we combined into one company right now. So we're really a private equity firm, is how I would describe us. We are heavy in real estate, and we do some value add, but I would say, the majority of our work is in the development space, and we can get into why I like development more than value add. Not that I don't like value add, but
come to the bus tour.
Come to the bus tour for that.
An hour long Adam
discussion. Yeah. Really, we're focused on that. And then we have a private equity arm to the business where we buy existing companies. So we can talk about that at a different time as well. That's really what it is. We're a group of entrepreneurs. I come from a background of working on extremely large deals in my previous life before starting NARRATE. And so here at NARRATE, you'll see, there's really not, we're opportunistic in nature, right? When we see a good opportunity, we have the ability to move and execute on it. So I think we're unique in that sense. Prior to, I've been doing real estate for 18 years now. Maybe longer than that, since 2006. Started in the corporate world, working on doing investment management stuff. Have been doing development in Colorado since 2011. So worked for a really large organization, one of the larger developers on the West Coast, and helped them start their Denver office back in 2011. Built a lot of stuff with those guys. Was kind of thrown into the mix very early on. Didn't necessarily know even what I was doing. But learned, was surrounded by great people who were a heck of a lot smarter than I was. And, was there, Holland Partner Group is the name of the company. Got to work on some iconic projects, a lot down in the Union Station neighborhood. Bellevue Station down Bellevue and I-25 was involved in those projects.
Oh, those were yours.
Yep. So, worked on the big Whole Foods deal down in Union Station, worked on the platform down there. So, with those guys, by the time I left, after being there 5 years, I was directly oversaw the development of nearly 2,500 units and about 400,000 feet of retail with those guys. Was there 5 years. Decided I wanted to get more local and out of the institutional space. So after that, I went and worked at BMC Investments, a group based out of Cherry Creek North, and was involved in a lot of development within that neighborhood, the regentrification of that neighborhood over the last 7 to 10 years, and had a direct oversight of the a lot of the development projects that happened there too. So that was really important for launching my own firm, because that was my first 2 jobs were very institutional. We're talking big, $50 million check was nothing. And now, and then went to BMC and really wouldn't have been able to start my own company without doing that. And learning, the ins and outs of high net worth individuals, more private investors. So that's really, I would say, where, combined with my previous history of development and then understanding, a little bit smaller scale development, I think was really well-rounded. So, just had the opportunity to probably 3,000 units at this point in time with, call it 400 to 500,000 feet of retail in mixed use type projects. So I've definitely, I'm not gonna say I've seen everything, but I've seen a lot and been in a lot of different situations with different types of projects, different size of projects, and have just continued to keep writing down information and lessons learned and get better on the next project than you were the one before. So definitely have a lot of development experience within the state of Colorado.
And that's, great background. Thanks for sharing, because that's one of the things like I always look for, because, I've already invested in this fund.
Yep.
So I'll probably invest more in the QEZ deal as well, which is one of the projects in here. And the number one thing is like, who is a sponsor? Who's a person?
Yep.
What's the track record, works experience? We're all rookies at some point,
Yep.
but I'm not investing with a rookie.
Yep.
I want to invest someone that's been around the block a few times.
Yep.
You have.
Yeah.
And
then I would say, as a company, as a with NARRATE, we've finished 3 projects, and then we're delivering another one here in May, over next to the 9th and Colorado redevelopment, over there. So, yes, a lot of experience with other groups, but we've also we've also done our own at NARRATE as well, and have a good pipeline, 3 deals right here ahead of us.
So on the left side of the screen here, real fast, this property is called the Aston. If you're ever driving down 25, right there at Platt Park, so right on the west side of 25, right after the underpass, you'll see the Aston.
Yep.
That's one of his properties, and that's this one right here on the left side of the screen.
Yep.
So you can see it.
You can see it, and
it's a real project.
Yep, it's a real project,
and it's rented out and it's stabilized.
Rented out, stabilized, performing very well. And then I would actually do a plug for Caraway as well. It's you can see that one driving down I-25 as well. We have Lincoln's Roadhouse, which is probably the best dive bar in Denver, and we kind of flank both sides of that. So, you see him driving every day.
Cool. All right. So if you guys want more details and actually see the projects, we've got deep dives on some of these for past content. And also we've walked the Aston in the past, and we're doing some more property walks on the bus tour in the future. So best ways, let's go walk properties that Adam has done and is currently doing.
Yep. And I would say, one just last thing, Chris, that I would throw in there is, we take a lot of pride in the developments we do. I think a lot of the projects that you see coming into Denver, Colorado Springs, for that matter, it's just they're out of town groups, out of state groups. They're coming in, they're trying to build it as cheap as they can, they're trying to lease it up as fast as they can, and they're trying to sell as quickly as they can. We just take a completely different approach. We're not a merchant build. I live in the Aston, actually, right? So kind of put my money where my mouth is. We just take a lot of pride, right? We might not be the lowest cost builder, but we think in the long term there is more value. There's more value to that. There are more buyers. It's probably a lower cap rate. You're going to get higher rents. All of those things. So that's something that we take a lot of pride in. We take a lot of time in good architecture. And I'm not saying we don't we don't have budgets. We definitely have budgets, but we do believe in building a quality product that's going to stand the test of time, that the neighborhood ultimately and the residents who live there are going to be proud of. That's something that's important to us. And you might say, hey, you're building an attainable deal down in Colorado Springs. you look at the finishes and the exteriors on this thing, it's still, yes, it is a more budget conscious project, but it's still not, we're not doing cheap product and things like that. It's still a very quality build. So it's just a matter of the right project for the right location for the right renter at the end of the day.
I love the passion.
So,
All right. So number one, great
Yep.
sponsor. Number two, let's talk about the market.
Yep.
And most importantly, the market cycle and the
Yep.
timing we're in. So a couple graphs here I put up is, I think a lot of you guys have seen variations graph, the 4 phases of the real estate market cycle. Phase 1 is recovery. Phase 2 is expansion. Phase 3 is hyper supply, and phase 4 is recession. Now, the entire real estate market is not all in the same thing. Based on the submarket, the asset class, different parts of the real estate market will be in different parts of this. So we're going to talk about this while this is true to real estate. We're going to focus on what it is like for multifamily, because that's what we're investing in. That's what you guys are building. So looking at I found this graph with some notes on here. So look at expansion. Expansion starts saying rents rise rapidly towards new construction levels, high rent growth in tight market. So, pre-2022, everyone remember the 10, double-digit rent growth returns, right? Right here, we are getting into this, very high rent growth, very tight thing, which, hey, that was a market in. At some point, the market changed with interest rates, expenses, a lot of supply came on, started hitting hyper supply, phase 3. So that was where, hey, rent growth was still positive, but decelerating, not 10%, maybe 4 or 5%. And then phase 4 is recession. Rents are below inflation and potentially negative rent growth. Well, we don't like seeing negative rent growth. It's very important to understand where we are in the market cycle, because we want to catch things kind of at the bottom of the recession and ride up the recovery. So here's another graph or another chart of the exact same one, but I like the way this website outlined it, where it kind of put the phases in here with it as a buyer's market or seller's market. So the 3 projects NARRATE has, they're projected to be delivering, early first half of 2027. And that's going to be in this recovery phase of seller's market. Now, depending on how long the cycle goes on, if you're a 4-year or 10-year hold, you might be exiting here in phase 1 recovery or phase 2 expansion. Hey, you're selling into the seller's market. That's where you want to be selling into. Now, the buyer's market here, this is where we are currently. I think we're kind of right here at the last third of the recession. And that's defined by increasing vacancy, low construction starts, low to negative rental rate growth, and also low absorption, to name a few things. So we're kind of like right here in this market cycle again for multifamily, Denver, Colorado Springs. That's what I'm talking about here. Hey, single family homes, you're in a different part right now, but for multifamily, this is where we're sitting. And so that's like the macro view of, hey, we all got to understand and play by the rules. This 4 cycle real estate market cycle, and we want to apply it to Denver and then ultimately apply it to the deals we're looking at. So next up was, here is the Colorado Springs overview CoStar report. And CoStar is probably about the best or one of the top areas to pull reports for commercial properties, multifamily. And I'm going to put in a couple stats on here. And we're using Colorado Springs, Denver, very similar trends overall, but just we'll stick with Colorado Springs on here. Last 12 months, negative 1.1 rent growth. That puts us here in this phase 4 recession, right? It's scary, but this is the ideal time to get in the market. Now, reading from them, however, new construction starts have plummeted. The significant downshift in apartment starts indicates that the market should find relief from supply side pressure by 2025, which should support stronger rent growth. So high level, what multifamily in Colorado is facing is demand is very strong. We just have a big short-term supply glut. So here's a graph of Colorado Springs construction starts. Orange is deliverables. And that little black is net deliverables. And what you can see here is the historic supply wave is winding down in the Springs with very few still under construction, down from the peak of 8,200 units in 2022. And Adam, we were talking about this graph. I'm pointing right in early 2025.
Yep.
You said you could point out the 2 or 3 projects that represent this.
Yep. I mean, there's not, especially downtown, right? Downtown, there's one project under construction currently, right? And I could make an argument on their forecast that line should be flat for the next couple years, right? I don't know. I know maybe one other project in downtown that's being talked about that I think is not going to start for quite some time. So we have a real opportunity, within that marketplace down there, I think, to build a project that, like, as you said, right? You look at some of the numbers now, it's like, okay, does it make sense to build? Well, it takes time to build, right? So essentially you're building out of I call it building out of the recession, right? So you're building as the market is recovering. And then when you're starting that lease up, right, you're hitting that point where you're starting to see rents really grow. I think the other thing while we're on this, and we're talking about supply and rents and things, is when we underwrite our rents on our development projects, our year one rent at delivery is equal to what the current market rent is today.
So he's saying in 2027, when they start putting tenants in these buildings, looking at rents in 2024 and 2025.
Yep, that's correct. Yeah. Yep.
Which is the way it should be. That's conservative underwriting.
We like to not, so you'll hear, if you're around development, you'll hear a trended versus an untrended yield. We don't, an untrended is where rents are today divided by your total costs, or, using an NOI based on today's rents divided by total cost. And then a trended is a lot of people like to grow their rents during the pre-development and construction timeframe. We try really hard not to do that. We in all of these we're not growing them. Like literally our rents in 2027 are equivalent to rents that we get today. So hopefully leaving some upside. Does it make your returns lower? Yes, it does. But at the end of the day, we want to be realistic in our assumptions. We don't want to, we would much rather overperform than underperform. So that's just a standard that we've set as a company and how we underwrite deals.
I like it. You're using realistic numbers in your pro formas, which is always one of my pet peeves. And you guys are using real numbers. And going through some of this more data here. So here is vacancy in Colorado Springs. Now, there's 2 vacancy lines on here. The blue is standardized vacancy, and the orange is the overall vacancy. Now, you can see here, this is showing that dotted line is Q3 2024, where this orange line, overall vacancy, has about peaked. So what is overall vacancy versus stabilized vacancy, Adam?
Yep. So your overall vacancy is going to take into account any project that is in lease up. So, you have a project, and if you pull stats, right, and it might have just delivered, you could have 100% vacancy, right? So that gets mixed into those numbers. So and then your stabilized is just, okay, these are properties that have gone through the lease up, they're old, it's going to include everything that is a stabilized property that has been not just delivered and in lease up. So I would envision, as you can see, as time goes on, right, those start gathering, those start getting closer, because that means you're getting through that and absorbing that supply. And you never see them completely touched, because there's, they're making assumptions that there's going to be, whoever put this together, CoStar, whoever, assumes that there's going to continue to be starts. So you're never going to see those lines touch unless there's absolutely no new construction going on.
And this took me a while as I got into development a couple of years ago, like really understand, because, hey, when a new apartment, like say it's 200 units, right? Like, the building is either, yes, it's ready to be leased up, or no, it's not. And it's either 0 units or all 2 units already based on a certificate of occupancy. So in that building of 2 units come online, it's 100% vacancy. And it usually takes about 12 months to lease up.
That's correct. Yeah.
So it takes about 12 months to become fully leased and then go from that new property to more a stabilized property. So that's why we're seeing some discrepancies on here. But again, going back to the market cycle, we want to be buying and building into declining vacancy or decreasing vacancy here, which is showing the signs of the recovery, which matches up with, hey, vacancy should be decreasing last quarter or this quarter, right around then. Now here's just another graph here showing rents. Lots going on, but again, going back, you can see 2023 and 2024 for Colorado Springs, we saw some year-over-year negative rent growth. Now, years previous to that, you saw some high rent growth, right? That was hyper supply. This is recession in here. Now we're looking at recovery. Now, these projects should be delivering in the first half of 2027, meaning, hey, that's when the first tenants are moving in. and then getting leased up and stabilized into, say the first half of 2028. So we're building and delivering into this part where very strong from the market cycle, and we're back to like decreasing vacancy or much better vacancy, and also back into strong rent growth. So this is all part of investing. Is, hey, as Adam said, this is a long-term investment. We have to use data and take our best guess, because what's Buffett saying? Be fearful when others are greedy, and be greedy when others are fearful.
And that's,
people are fearful now.
People are fearful now, right?
Which is usually a great time to invest.
And you're not seeing a lot. A lot of developers are not doing what we're doing. The minute interest rates went up and deals became harder to make financial sense of, they put pencils down, and their pencils are still down right now.
Well, not only that, sorry to interrupt you there, but this is something I think it was the Aston was an example on here. Like, he did a couple of projects that, hey, they delivered when, hey, the market was going crazy, rates shot up, expenses shot up. But you were savvy enough to take a little bit higher interest rate, but you fixed long-term debt. I think for like 7 or 10, or I forget. You fixed long-term debt, and that was one of the biggest differences to where your project was very successful versus other ones where it was not successful.
That's correct.
Which a lot of people not do. You and Narrate were the minority, which is that's the type of person I want. We were at the captain's chair.
Conservative in our nature there. I wish those loans were still around. They're not around anymore. And not that we.
Hey, be glad you got them though back then, right?
Great. So I mean, I think that goes back to, we won't get into it here, but depending on where you're at in the market cycle, depends on the type of financing that you can get, and B, that you put on.
I see a great comment here. Someone said stock market is still not fearful enough. Yes. So here's the last slide for Colorado Springs data, and we'll move on to the deals. This is forecasted sales price per unit. So again, this dotted line is Q3 2024, and you can see what the sales volume did. Hey, big in 21, big in 22, and just very much tailed off in 23, 24. This blue line is Colorado Springs price per unit. Green line is the U.S. average. Ignore that. Care about the blue line. What do you see here? We expect prices go back up. We're probably at the bottom of sales price right now. Again, if we're delivering in 2027, and if you're doing a 4-year hold or longer hold, hey, you should be delivering into a stronger market, and the prices should be higher than the last peak of the market cycle while we're still going up.
That's correct.
So I'll recap here. This is the commercial multifamily version of what happened in real estate in 2008, 2010. So if you all wish to go back there and buy properties in 2010, 2011, in my own view and where I'm placing my money, I view this as the commercials reckoning, and this is our 2010, 2011 of the residential world, last market cycle. All right. So the second half of the webinar here, we're going to go through and do a high-level overview of the 3 deals. So, Adam, we're going to start with 1000 South Logan, which is the Wash Park property. Give us the overview on here, please.
So, and I'll keep it very high level. For anyone who's interested, there's a lot of details within this presentation. And then, we'll have follow-up bus tour, follow-up webinar to go in depth on numbers and those type of things. So I'll keep it pretty high level and really probably just talk about business plan for the most part here. We'll hit on a couple things as we go along, but 1000 South Logan is a 29,000 square foot site located in Wash Park. So Wash Park, as most people on the webinar probably know, huge barriers to entry in this marketplace. Full of mostly single family residential that I don't even know what the sales price is over here. High, I know that.
7 figures.
7 figures. We had an opportunity to buy this site a couple of years or about a year ago now. We closed on it in December of 2023. And originally started out doing our design for the project. We ended up meeting with the city, and they said, hey, we think you should look at a rezoning here. And basically the rezoning, what that allowed us to do was build one building versus 2 separate buildings on the site. And it just had to do to some of the nuances with the existing zoning that was on the site. We actually on Monday, I think I shared this with you, we got our 10-0 unanimous approval for the rezoning effort here. So while we did lose some time in our pre-development efforts, it makes our building extremely efficient compared to having 2 buildings.
It's cheaper to build 1 building than 2.
And it's cheaper to build 1 building than 2. So that was a huge win. Our business plan over here is predicated off of the success that we've had across the highway in Platt Park, which is less than a quarter mile away. You can see here on the screen, you see the Aston there, you see the Caraway, and then you see 1000 South Logan. So that's, really, they were successful deals, but if we could go back on the Aston in particular and change some of our unit mix there, we would have. So really we're looking at large units here, that are going to have higher end finishes, right? We're going after the higher end demographic at the end of the day, because that's a neighborhood that, this is a neighborhood that calls for that. And what we found is, these are a lot of times renters, renters by choice, not by necessity, meaning they could go buy a home, they could go buy a townhome, they have the funds to do so. They would prefer to rent for one reason or another. And if you deliver on, location number one, finishes number two, and this is not in an order, but, finishes, layouts, the appropriate amount of amenities, you hit on all of those things, people are willing to pay you higher rents. And what we saw over to Aston, on our lease up was, our 1-bedroom larger units. And when I say that, I mean 850 square feet to 925 square feet. Those actually rented at a higher per square foot than any of our other units in the building. That includes our little 500 square foot units. So that right there tells us we knew there was demand for it. We just didn't know how deep it was. Those were our first units to lease up as well. So it's not like we held out and waited. So that's really what, predicates our business plan here. And we do have a handful of smaller units. We have a couple stacks of 2s, but really large 1-bedrooms. That is the majority of the unit mix on this project.
And that's one of the great things. We're like, hey, you got other projects successful. We can always looking back and always, do things a little bit better. Hey, take what went well, and the other say, what does market want? And so that's incredible insight into the 1000 South Logan project. Something else that I think this is it right here. So this is what's called a covered land play.
This is a covered land play.
So that means they bought the site and there's already a 20-unit building on there.
That's correct.
And come full circle, this is actually a deal I looked at with a value add group years ago. Numbers not make sense to buy it, fix it up, and reposition it. It was just not enough meat on the bones there. So I looked at it that way, and then come back later. Oh, NARRATE bought it to, because it's a great property, great location, but the value add numbers didn't work out where it needed a brand new building and the size of the amenities you talked about to fit the Wash Park neighborhood. And so great play there because, hey, there's a unit on there. It's already bringing in an income and cash flow, which helps with a lot of expenses along the way.
That's correct.
So you can see here, there's a couple spreadsheets that we're not going to dive into on here. Everyone can download the spreadsheet to review it in detail, go through the numbers. And what we're going to do, you can see there's a lot of spreadsheets on here. We're happy with people one-on-one to do a more deep dive, but also, I forget the exact date, but in early February, we have a follow-up call scheduled, do some Q&A, but actually do a follow-up deeper dive spreadsheet and writing onto here.
That's correct.
So you guys come review this, come get the high-level stuff, and come back for that next layer of the onion to go into a lot more details on here. So lots of spreadsheets to look at. The rent roll you're talking about.
And it might be sticker shock a little bit. But I can tell you, our net effective rents across the way at Aston were actually closer to 350 a square foot. We're at 340 here. It's skewed, so if you look at the residential averages above in the table, it's skewed a little bit because we are doing the affordable housing here.
Which is a Denver County,
city and county Denver mandated.
2 years ago.
2 years ago, we just didn't hit the deadlines that they required. Which we could talk about that whole thing on a separate webinar. So that's why we kind of pull it out down below and say, hey, here's your average rent, here's your average per square foot, taking the affordable stuff out.
So the rent comps there. So a really good thing. This is when they bought the land. Talk about, because you guys bought it at a great low basis. Like 142 a square foot.
142 a square foot.
I think average comps were about 198.
And there's some 5-story dirt in there. There's some 3-story dirt in there. But we, just knowing the marketplace, the rents that we could get over here, this was a site that we actually had our eye on for a couple of years. And we ended up buying it for $2 million. actually they might have had it at 6.8 million actually when they first started it, but we ended up buying it for 4.125 million. It's a funny story of how we actually put it under contract, because it was one of those ones that we didn't think we'd ever get, and we got a call one afternoon and woke up the next morning, had it under contract. But yeah, we know this marketplace, we know this, we really know what you pay to make a deal work over here. And we think we bought it at a very good basis here, and we just kind of let the price come down until finally we're able to transact on it.
So you bought a location and then you bought it at the right price.
Yep.
And these are all very important variables.
The location
in there.
is, we didn't hit on it earlier, we're location guys all day every day.
Yeah, location.
That's what they always say, and that's probably what's allowed us to continue, to not just get lose our shorts, during this. I know technically we're not in a recession, but real estate's been in a recession since for the last 2.5 years. No doubt.
Yeah.
And so that's when you have yes, when everything is going great, right? A cap rate in Aurora is equal to Denver makes no sense, right? And there's not a huge bifurcation of cap rates between a Class C product and a Class A product. But now, but you have to prepare for the downside, right? And that's why we pick location all day, every day. And kind of the three sites we're talking about today all have great location. There's different characteristics that go into make it a great location for the product type. But at the end of the day, they're great locations, and that's what we focus on most. And then you have to buy it at a fair price, right? We're not looking for discount deals, but you can't overpay either. If you overpay for land, that can get you in trouble too.
Yeah. So some other slides here for South Logan. We'll move on to Canopy for sake of time. So we can spend about 10 minutes on each property. But again, go back, read that personal slide deck, and also Canopy and Weber. Come back with us for a week or two. We'll do the deep dive. But Canopy is the downtown Colorado Springs.
That's correct.
Property. Tell us about this deal, Adam.
Yeah, so Canopy is a 183 unit project, so a little bit larger, downtown Colorado Springs. It's one of the best corners down there. It's at the corner of Cimarron and South Nevada. For anyone that knows Colorado Springs, it's where all of the new development's going on. We're 2 blocks away from the new soccer, switchback soccer stadium that was built down there. We're a handful of blocks away from the new Olympic Museum that was built down there. So all of the new development is going on in south of downtown. And we had an opportunity to pick this land up at a very good basis. $82.50 a square foot when land comps were going for well over $100 a square foot. So we feel really good about the land basis here. We've since added to originally it was a 28,000 square foot site. It's now a 38,000 square foot site. We bought an extra parcel that is part of the development. This one is interesting because Colorado Springs is just an interesting market that's really, I would say it's definitely been hit a little bit hard over the last 2.5 years, but prior to that, it was the darling child. And we are just huge believers in Colorado Springs long term. The politics down there are great. When you compare it to right or wrong, different than Denver. It's a lot easier to build down there. It's a lot more welcoming to growth. The cost of doing business is less down there. The ease of doing business is a hell of a lot less down there.
Well, I'll add on there too. I will recommend anyone. I think a lot of us are Denver based in the webinar. I mean, I think everyone's been in Denver. Hey, go drive around downtown Denver, and you know what's there, not there. Go drive down Colorado Springs. Very different vibes and feel of what's going on.
Yep.
And that, in my opinion, says so much about. I'd rather go to downtown Colorado Springs. I would go to downtown Denver now.
100%. And then, and then we started seeing the big boys come down there too, right? And that's a sign that the market is growing, right? Graystar's down there, Widener's down there, Formative out of Denver's down there, right? And these are all like huge, legitimate development companies. So when you start to see that, it really gives it some legs. I think overall, industry down there, right? It's transformed a ton over the last, I'll call it 7 to 10 years regarding, used to be a military town. It's definitely evolved out of that. So that's really, I just want to go on why Colorado Springs, like those are a lot of the reasons. There's not been a lot of supply. This is a report from, and I can't remember where I read it, but, this is about 9-10 months ago, but it was 42.5% of renters who are leaving the Denver MSA are moving to Colorado Springs. And
that many are migrating from Denver to Springs.
Yeah. So that was a crazy stat to me. They're projecting that I think it's by I can't remember, it's 2040 or 2050. The state demographer says that Colorado Springs will be larger than Denver, and that's Denver proper, right? That's not the MSA, but that just says a lot of things for growth. It seems like every time you open up the paper, there's a new company that's relocating down there, and it's high-paying jobs, right? It's there was a recent one that was like it was a tech company of some sort. It was 600. I want to say it was 600 jobs, and I think the average pay was 175,000. Right. So in the past, I think Colorado Springs was looked at as a cheaper alternative to Denver. That I wouldn't necessarily say that's the case anymore. Yes, overall it's probably cheaper, but new product is still not super cheap down there. Right. So that tells me that people are moving down there, strictly for the lifestyle.
Yeah, and I agree. I think over the next 10 years, I think Colorado Springs will see a bigger pop. I'm just talking like growth and running like the big macro trends. I think Springs has a lot more like upside and pop than Denver does. Hey, they're both great investments.
Yep.
But I think Springs will see, if I have to bet you a cup of coffee, I think Springs will see a bigger pop over 10 years.
I do too. And you started seeing that before interest rates started going up.
Yeah.
You started to see some, there was a trade down there that was at $485,000 a door on the exit. There's a lot of positive things going down there. A lot of big investors wanted to be down there and couldn't figure out how to, because there's just not product type downtown. So I think overall, looking at all those things, I think it's a huge benefit. So obviously the site, the location, the upward trend over time, and then kind of the cherry on top is the QOZ here. And that's qualified opportunity zone. There's some pretty incredible tax benefits, which we're going to get into in a different call or a different webinar, but and can talk about it more, but won't go into it too deep. But there's some huge tax benefits that I think are better than a 1031 long, if you're looking at it long term. And I think you throw that into the mix in this type of deal, it's just a great opportunity.
Yep. And just for clarity, if you invest in a 3-pack, you don't get the QZ benefits.
That's correct, yep.
That has to be a direct investment in Canopy with a few other paperwork things. But we'll go into, if you have any questions or confused, reach out to us. We'll guide you. Because I'm investing in a 3-pack.
Yep.
And high probability of investing in Canopy as long as the 4-plex timing sale lines up.
Yep. And I think that's one of the things, Chris, I'll mention just really quick to anyone who's listening, is while we did set I think the diversification is a great thing. Different product type, different markets, different sub-markets within those markets. There is opportunity to directly invest in just specific deals as well, right? If you were to say, hey, like I only want to be Colorado Springs, you could do direct investment into the 2 Colorado Springs deal. If you said I only want to be Wash Park, Denver, so there's a lot of flexibility that surrounds this the 3-pack here.
Yeah. Awesome. Well, like I said, we will let you guys go through a slide, but lots of data on here for spreadsheet, exit, comps, timeline, the cash flow statements, data on, hey, great land basis or great basis they bought on the land, exit sales comps. So go through all that in detail, and then come back to our next call. We'll go into a much deeper dive on the underwriting, especially when it's a chance to like review it yourself. It'll be easier. I see a question here. Can't 1031 to QZ, but can a non-QZ, maybe I'm misreading that, but can in a non-QZ like the Denver development? It's complicated. We'll follow up with you offline so we don't get in a rabbit's hole. A lot of it depends on that answer. So we will follow up with you after the call and help you get figured out on that. All right, moving on to Weber here. So this is our last project. We have about 5 minutes to cover it.
Okay.
So this is the Northern Colorado near the UCCS campus.
Yep.
Tell us about this project, please.
Yeah. So this project's pretty unique in a sense that it's an attainable housing project, right? Our rents here. This is a 3-story garden walk-up. I believe it's 4.1 acres. Our land basis is really, really strong here. It's an up and coming area, no question. It's a 3-minute drive from the University of Colorado Springs.
Yep.
You can see it on the map here. I actually mapped it out the other day, and it was 3 minutes from the time we left the site till we got over to the campus.
Amazing location.
The interesting thing here also is that there's 12,000 students that go to school here. There's no on-site campus housing. right? So there's a handful of properties in our competitive set that I've never seen a unit on because they're always 100% full. So it's an interesting we have a partner on this deal that we're working with, and they were originally looking at doing industrial here, like small scale industrial. And we said, there might be an opportunity here to do something that's a little bit different. So this one's got, so I think the merits of the deal location, right? Like we talked about earlier, building the right product type for the right location. I think that's really important, right? We're not going to come down here and build a podium deal. That would never make sense. We'd never get the rents to make sense of it, but we can get enough land to build 3-story garden walk up. Still a nice product, but heavy. You'll see heavy on 2s and 3s. And that's purposeful. One is the reason we did that is you have the campus, right? So you're probably going to have roommate situation. So we want to be able to accommodate that. This is not a student housing deal, but we think we will get students from the university that rent here. And also it's a blue collar neighborhood, right? And those folks need affordable, attainable housing too. So that
the missing middle.
This is a missing middle development. That is what it is. And I think the opportunity to be able to do a deal like this, new construction, and hit that marketplace is pretty cool.
Can you talk about, because one of the reasons that makes it even sweet is that you got some really cool HUD financing.
Yeah.
Give us a high level, because you've explained like 3 times. Every time you explain it, I learn a little bit more.
Yeah. So HUD financing, it's called a 221-D4. It takes about 12 months to get through the process. We're through the first 2 of 3 phases. And essentially this is done by HUD, which is government-owned agency. And their financing right now just blows everything else out of the water. They are very particular in locations and markets that they'll go into. So it's pretty unique to be able to get the financing. It's a lot of paperwork. It is not an easy process. Like I said, it's a 12-month process, but if you can get through it, the terms are pretty great. So basically on this, I don't know where our rate sits today, but when we did put together the underwriting, we're looking at a 6.15, a 6 or 6.0 rate.
Right? What would market be?
Market today is 7.5 to 8.
So you're going to be
traditional
150 basis points or so less than market rate. So think about that. 1.5 interest drop in interest rate. Huge right there.
That's huge. And it's probably up because I know treasuries have been up, but we don't lock it in until we still haven't locked the rate in. So maybe we should have moved a little faster and locked it in. But I think at the end of the day, the other thing that's interesting is it's a 40-year loan. And it's fully assumable. There are some penalties and those type of things if you get rid of it in the first 10 years. First 7, you're really locked for the first 7. I would say you don't want to do it because it's not going to be financially smart to be able to do that. But you get 3 years interest only, and then it goes to 40-year amortization after that. So it's a great financing tool. Feel pretty fortunate to be able to have that on this project. HUD is really an advocate of affordable housing at the end of the day.
Yeah.
And they don't do all affordable housing, but by doing affordable housing, they just release some new requirements that are even more beneficial to if you hit between that 80 and 120% AMI threshold. We actually just got a note right before this meeting from a team member that we're definitely well within that range. So that's, I think, one of the cool things about this. You get to invest in new development, and also, I think do something good for the community rather than, yes, we love our great projects in Wash Park that are at the top end of the market, and think that will be very successful. But we can also, we also do other type of projects, and I think this is great, and it's using kind of our knowledge and skill set within within development of apartments to deliver something that's, I think, highly needed in every market out there, essentially.
And you're getting an amazing government subsidized loan that hey, the free market could never do that, but when the government wants to help steer more attainable housing, they do programs like this.
That's
while
correct.
It's a pain in the butt in the paperwork.
Yep.
Man, the juice is worth the squeeze.
The juice is worth the squeeze. Yep, that's correct.
So again, we have lots of data on here for spreadsheets. So review all this for assumptions, exit cap rates, the pro formas. I'll let you guys go through that in detail on your own. And next, we'll circle back around 2 weeks for a detailed underwriting on here. But want to wrap up here with the investor returns. So this table in the lower right, this is the same one we saw at the beginning of the webinar. This is the combined short-term hold. And then these other ones, these are just each individual project.
Yep.
And so this combined is just the weighted, a third of these put together, so you can review that. And again, same thing. We're doing the base case assumptions in that top row of 5.5 cap rate, or for Weber, and all these are the base case with a good chance of seeing cap rates go down or cap rate compression, which means we make more money on the sale on the back end. And so you can see here, hey, depending on where it ends up, hey, it might be a low 20 IRR, might be a mid 30 IRR. So nice spread there. And then here's a table about the 4-year cash flow analysis. And then here's that same table for the 10-year hold, each one individually broken down, and the combined one as well. Let you guys dive into that, then get your questions compiled. We love people that break out their pencils and dig in the Excel files. Now, if you are interested, our whole goal here is we always want to deliver like top-notch investments with, hey, what these projects are doing, with top-notch sponsors like Adam and his NARRATE team, and deliver really exceptional deals that make sense in the current market cycle we're in. But it's always important for people to go out there and do your own due diligence. And this is why we are doing the deep dive call on February 6th. And then February 20th, that's our tentative date for the bus tour. Hey, come meet Adam in person. Come drive the site, spend a half a day with Adam and some team members on a bus and get to meet them and learn them. But this investment is open for accredited investors only, with $100,000 minimum investment. We can take cash or IRA or retirement funds money. This fund will be closing the end of Q1, so March 31st of 2025. But it may fill up before, but also have the money. Go ahead and invest sooner, because, hey, once your money is in the door, you're starting to accrue your return on there. So if timing works out, invest sooner if that makes sense for you, but you do start accruing terms. And again, the legal docs are ready for this. So that is the actual offering, Hunter. If anyone's interested in the legal docs, let us know that you want them. Give us a ballpark amount for what you're interested in investing. We'll send you the legal docs for review, which has all this outlined in the legal mumbo jumbo. We'll get you a soft spot reserved for the fund and make sure we get you plugged in our call, reserve you a seat on the bus tour. And then also should be later this week, we'll have a spreadsheet, a fairly simple spreadsheet ready for people to go out there and, hey, if I plug $100,000, here's what I could expect in the return spectrum, so you guys can see it. If any questions on here or want it, drop it into the chat or email ir@propertyllama.com, or on my email address. I'll forward it on as well. But we'd love to get you more details and get you in touch with more in-depth underwriting with Adam and the team. So I know we got like 2 minutes left. If you got any questions, drop them in the chat box here. But Adam, I know you have to run to go to a property walk here, and I think you have to be out there in like 3 minutes. So we'll end timely, so you're not late to your next meeting. Any parting data points or words of wisdom you leave on here?
I think at the end of the day, I think we hit on a lot of them, and I think it's just one of those things, where we're excited to be able to offer. This is the first time we've ever done this, where we've been able to offer investors an opportunity to invest in kind of one fund across 3 projects. And
thank you for the diversification, by the way.
So and honestly, like, it's just the timing lines up pretty well. As well for all 3. So, we're gonna have a little bit of different start times on them, but generally speaking, they're all on similar trajectories and paths. So, and I think we're excited about, continuing to work with you, Chris, and the rest of your team and investors, and, ask us any questions at all. Like, we're very open book. We don't hide anything. We like to, it's not always the best news, but we're very open and very honest about where things sit, and we can get into a long discussion on why development and why now. And we went into it a little bit, but I think it's really delivering into that that market recovery.
Yeah. So thank you so much, Em. I'm excited. Again, I've invested personally in this fund already. I invested in Q4 of 2024. And most likely, as long as my timing works out with my fourplex sale, I'll be investing all or a big chunk into the canopy directly for QOZ benefits. So I'm a big believer in here. Write my own checks. Met Adam, done the due diligence. If you guys have any questions, for me, from like the investor portfolio optimization standpoint, reach out to me for details on the project. Adam and the NARRATE team is that. But thanks so much for coming out. Let us know your questions. Actually, I think, do you have time for one question?
Sure.
This is a good one. What are the odds or probability for any capital calls for any of these projects. So a capital call means beyond the initial investment.
Yep.
Someone's go according to plan. Hey, we need some more money, investors. You guys send more money.
Yep.
Or there's some bad stuff.
Yep. So to date, of the 3 development deals that we have delivered, we have not had to do a capital call. We have one that's under construction right now where we had an insurance event that there possibly might be one. But what we try to do is we try to go in. What we do is we go in with 3 different sets of contingencies in these projects, and our general contractor has a contingency on his side that he's carrying for the hard costs on the project. We carry a soft cost contingency that is dependent on the size of the project, is dependent on the amount. Usually it's $300,000 to $700,000. And then the last component is we typically go in minimum 4% owner contingency as well. So and when I say as a percentage, that's a percentage of the overall cost of the project, right? So we're increasing the cost of the project by 4 to 5% typically, just to take care of things that
The rainy day fund.
that you just don't know. I mean, when you look at anything that's built, there's a lot of details that go into these things and get missed. I think the other thing I would say too, to help mitigate that risk is, we work with a lot of the same teams over and over and the same consultants over and over. And, I think there's a huge benefit to that, general contractors as well. There's a huge benefit to that because, if you're working as a team and all rowing in the same direction, you tend to work through issues, missing details, those type of things a lot better than if it's a first time. And not saying you don't work through it, right? It's the people we chose to work with, right? Like we're going to work with people who are committed to operating their business that way. So we really try to get the right partners, bring the right contingency to the table, have a key component is good consultants with very detailed drawings. That's important as well. So while I can't sit here and say there will never be a capital call, so far we haven't had one, and we try to really plan for any unknowns that might come up.
And I'm really glad the investor on the call asked that, because that's a key question right now to be asking, because if you guys have been around syndications or funds for a while, I'd say a lot of operators out there, especially delivering the last couple of years, they've had capital calls. They've had deals completely fall apart. I mean, like zeroed out.
Yep.
And you delivered a few properties. Hey, you took your curveballs. But you still delivered. No capital calls. No major change the business plan. So it just kind of goes back to like track record and your guys's conservative planning as well to help like set good guardrails in place.
Yep. It's all about setting good guardrails, and there's always going to be things that come up. I'm not going to say there isn't. There's always things that come up. It's just a matter of making sure that you understand where your big risks lie in the development, and making sure that you're planning around those. At the end of the day, hopefully we're coming in on budget, or potentially returning capital at the end of the day.
Cool.
The first project we did, we actually came in under budget. So the last couple have been right on kind of where we thought they would shake out. So
awesome. Well, excellent job on the no capital calls. That's something I said, that's a big question. And also, Adam, thank you so much for coming out. Thank you for giving us the opportunity to invest in it. I know you got to run. So we'll wrap up here, and good luck at the next property walk.
All right,
everyone out there, thank you for coming out. You got any questions, want spreadsheets, bus tour, drop in the comment or email ir@propertyllama.com, and we'll get you all the details. Thank you so much. Bye-bye.